and more. Okay, so I apologize for that. Chuck, I didn't start the recording until just now, so I missed the premise of your question. Is it better to, with the success you had today on likely bullish spreads that you opened yesterday, and you had all of them expire worthless today, would it be better to open the positions on Wednesday or open them on Thursday as you did? Okay. Now, as I mentioned, you picked a good day. You see what the market did today was sort of renewed hope, optimism, and later in the day some news came out about tentative agreements on some of the portions trade-wise between China and the United States. So we saw a good ease of that sort of fear that's been lingering with this whole trade debate and a couple other factors out there in the market as well. So the one-day bull put spreads from Thursday that they were opened here until today looked really good. Wednesday, you probably did pretty good as well. Wednesday was a good light up day. Came back down a little bit on Thursday, but if you were opening them here, you're probably a couple points out of the money. I know we're looking at SPY, but just in general, if the market performed like this, they were still above where your price was, and then today the good day. You might have gotten an extra maybe 4, 5, or 6 cents premium from Wednesday to Thursday, depending on the position, your range out of the money, of course, the probability that you were looking for. So this was a good day. Monday might not have been a good day to open those spreads because you would have been in trouble on Tuesday and maybe even into Wednesday before it started to recover. You might have managed half of these positions, but he just wants to know about Wednesday to Thursday for these sort of one-day, two-day out trades. Wednesday you would have gotten a higher premium. The market was depressed and you had an extra day, but again, they still probably all would have expired worthless. Okay, but that is a interesting one-day view, isn't it? Oh, sorry, folks. Let's go forward now. Oh, sorry, and talk about how, naturally, not all Fridays are the same. Now, if you knew because you looked Thursday morning before the U.S. markets opened, or you looked Tuesday night prior to Wednesday's open, and you had a sentiment already about what the Dow was going to do, and then you're going to pop in right away and try to open spreads. Well, the open was usually probably down or up to begin with. You would have had to have that guess the day before. So you probably would have had success, and you did have great success today. I'm going to assume you would have had success if you'd have opened positions Wednesday, October 2nd or Thursday, October 3rd for Friday, October 4th, assuming these were bullish. Opening positions on September 25th or 26th for the 27th, if you were doing bull put credit spreads, would not have been profitable. Neither would any opening you would have done Wednesday or Thursday, the 19th of September, for the 20th. And here you would have been probably at maybe 65-70% winners, going from the 11th and 12th to the 13th. Bull put spreads would have been good here, of course. But from Thursday down, you might have lost on 5 or 6 of the 15 or 18 trades that you opened. And they might have had large losses that countered the bigger gains. Okay? Now, I know if you were looking on Thursday, you might have had a sentiment that the market was going to go bearish. For the next Friday, you might have opened bear call spreads. On the 26th, you might have opened bearish positions because something that you had, vantage point, something you read about the Dow or the SPY gave you a hint that the market was going to pull back on Friday. So Thursday, regardless of what happened, a little bit declined, and you felt the decline was going to continue. Maybe the bearish positions would have worked. They would have worked here as well. Bullish would not have, even with 90% probabilities, even with going 3 or 4% out of the money, you still would have lost on the bullish positions because the market fell that day. All right. Now, to the main question. Sorry about that. Something happened here. Oh, so the main question, can you offer advice on scan settings and using the ideal day of the week for this type of trading? Purchase all your positions Thursday, would Wednesday be better? Again, we sort of just covered that. I got ahead of myself there. But, you know, depending on whether you're bullish or bearish, Wednesday would give you extra time, an extra return, but it also gives you more time for the positions to go against you, depending on what happens during those market cycles. And we're just looking at the past 5 Fridays here, the ones that are highlighted. 2 bearish, 2 bullish, and of course just 1 there. So let's take our bullish one, our previous bullish one. We know what sort of happened today. But let's assume we start with Thursday. What criteria would I might use? Well, I'm probably going to use a days to expiration of, let's say, 0 to 3 days out in time, whether I'm searching on Wednesday or whether I'm searching on Thursday in the vertical spreads. I want to be at least 2% or more out of the money. I'd love to be 5% out of the money, but I know there's no way I'm going to get any reasonable credit going that far out in time. I still want a good probability for that 1 day, 2 day, 3 day period. 75% or more, 80% probability of expiring worthless or more as well. Okay, Chuck did add that he did some bull and some bear, which is kind of tricky in that case. Sam's comment is he thinks Wednesday will expose to more risk, and the market is driven by different tweets and outside factors, so it's a difficult question. It is, and the question is made a little bit more difficult in trying to prove it based on one factor I'll talk about in a second. So yeah, I'd like to be 5% out of the money. I'd like a 90% probability, but I still need a credit that meets my goals. Even for a 2-3 day trade with multiple contracts, 2 cents, 3 cents is not going to cut it for me, okay? In any case, what else do I need? No earnings between now and expiration. Need to research for no other events. Pending patent lawsuit, Johnson & Johnson we've seen is getting hurt by a lot of different things there, so we got to make sure that no rulings are coming out, no earnings, no surprises. I still would like to see some volume in open interest. I don't want something that expires in 3 days or 2 days that has very low volume and very low open interest. It's going to be more difficult to get out of. I am going to remove personally, I would, inverse ETFs. You have a direction you want to go, right? So you don't want to see an inverse ETF in your bull put spread because you're bullish, because that would actually lose money. And I'm likely going to avoid the 2x and 3x ETFs, because even going 3 or 4% out of the money with those higher volatile securities, on a day like today, the bullish 2 and 3x ETFs might have jumped a lot more. And if I was in a bear mode and I was wrong, might have quickly shot through both my strike prices. And there's this little checkbox that's in there to just look for one result per security, Chuck. And I just tend to do that so it doesn't grab 5 of, say, Sarepta Therapeutics, which will have a high implied volatility and will probably come up in the search if you're sorting by highest return. Okay, so I want to narrow that down a little bit. All right, here's just a quick view of those settings that I mentioned. It's created in a search on our webinar account for today's experiment. Set the expiration time frame to all expirations. Days to expiration 0 to 3. Just so any expiration weekly, monthly, but limiting the days to 0 to 3. I'm looking for a net credit of greater than 3 cents. Really, I probably want 5 or 7 for this 1 or 2 day trade. I want to be 2% out of the money. Hey, I'd love to be 3 or 4% out of the money and a 90% probability, but that's not going to give me the credit I want on a 1 day trade. I did enable the 1 result per security. This option bid greater than 0, I just want to make sure the option I'm selling doesn't have a 0 bid. With midpoint, that might be okay. If it's a 0 bid and a 15-cent ask, I might get 7 cents for it and only pay 2 for the long. I'm still at 5 cents net credit. That might be okay. I mentioned the probability greater than 75. That's lower than I normally look for. On my 2-week out spreads, I'm 85% or higher, but I've got to give a little bit of leeway here to still get the credit that I want. Earnings, not between now and expiration, and I'm excluding ETFs. The ETFs I remove personally, which are the inverse and the 2x, 3x ETFs as well. Okay, so that's the settings that I ran this little historical search on. We're going to take a look at right now. Sorry about the size, but it's easier to do it here and get the screenshot for you than it was to do it on the site for right now. Running that criteria I just showed you on October 3rd, 1 day remaining to October 4th expiration, the top 15 results sorted by percentage return. And you see here we have a mix of net credits. The high implied volatility Sarepta position, 59 cents. 12 cents here for PCG. Beyond, 21 cents at the time. 8 cents for First Solar, matching the criteria, and Lyft, a net credit of 8 cents. So you've got a decent mix here, probably an average of 20 cents or so. Not too bad. Most of the strike prices are close, 1 point, 1.5 points, 0.5, 50-cent spread differences. I didn't restrict that This one here is a 2.5 for shop. It's probably because they don't offer single strikes at the 317 price. Okay. But down here, here's the returns for each. You see that there was one that's at the full loss, and it wasn't even that big of a decline. In 2 days, it was a surprise, but HPQ went down from 1840 to 1664. This, by the way, is the historical tools and power options, running the search and then printing out the calculate group results. So this position lost about 2 points, a little bit more than 12-15% decline in 2 days, and you'd have taken 100% loss on that particular bull put spread. But 93% were successful, and you would have had a 25% total return. This is using that criteria, running it on October 3rd for October 4th expiration. And that was a green day, wasn't it? Not the band, but that was an up day as well. That was one of the 2 up Fridays we've seen in the last 5 cycles. Now, not to prove Sam's point, but this does show something interesting. Opening the same positions on Wednesday, October 2nd, for the October 4th expiration, 2 days to expiration now, we see some different results. That's something that's interesting. The results are going to change because even though it didn't seem like we were using very restrictive criteria, we kind of are for a 1 or 2 day trade. All right? We're trying to look for the best of the best return-wise. I didn't even use any stock criteria. Stocks in an uptrend, positive MACD, which I would likely use for any bull put credit spread. We didn't with this and left it open. We just removed the earnings. We see some good returns, but now this is interesting. 12 out of 14 that were opened on Wednesday for the October 4th expiration were profitable. It's 86%. But it's only a 13.2% because 2 positions, Alta and Tesla, would have hit the full 100% loss in 2 days, a 12-point decline in Alta from 262 to 250, and a 11 or 12-point decline in Tesla from 243 to 231. You can't really see that. Sorry, I circled too big. So from 230 down to 231. All of the others, though, looks like they got the maximum profit on the position, but those 2 losers, as Sam mentioned, a little bit more time for things to go against you, increasing the risk. Some stocks were still up in this case. You see Amazon here went from 1713 to 1739. Let's see, was there a small, there's a small mover here of 3184 on JWN to 3249, but we started out at 31. Keep in mind, I was on 84 cents out of the money, but it still gave us a good return on the position. Well, that's great. So what have we seen here? Well, with one simple example, very small sample size, we've seen that the number of winners percentage-wise and the number of returns from last Friday's expiration, same criteria for a bull put spread. We would have been better opening on Thursday than opening on, Wednesday. Okay, but that is a very small sample size, and the market was relatively choppy. Same criteria, but opening on September 26th on Thursday for the 27th expiration, what do we see? Well, we have our top 15 results here. We've got 1, 2, 3, 4, 5, 6 at 100% loss in a day. It blew below both strike prices of our positions that had a 75% probability, or at least 2% out of the money. One position at an 80% loss, one at a 36% loss. And we do see some good leverage returns. 7 out of 15 were successful, under 50%, and those top trades sorted by return that match the same criteria we did last Thursday. But on September 26th into September 27th, we would have had a loss of 33.7%, which would have done what? Well, if we lost 33.7% on the 27th, and we still had our average 25% return for the 15 positions on this cycle, or on the October 2nd, I should say, to October 4th cycle, we're still negative 12% or so on what we had allocated to this portfolio. going further back, September 25th opening on Wednesday, it was almost the same numbers. Okay, less than half were profitable, 7 out of 15 again, and the loss was a little bit lower. It was about 32% because there was a little bit more time premium, but those 4 or 5 that took the 100% loss actually were still in Wednesday's results and still took the 100% loss as well. So you might have gone 100% bearish at that time. You might have been fortunate enough with your other software to do the bull put spread and just pick these 7 winners, and you happen to pick the 7 winners on the bear spread. But what I'm attempting to show you is this is a really hard question to answer, because what it's not taking into account, other than market movement, is fluctuations in implied volatility. Now, sure, if it ends above the strike, it ends above the strike, and you get the 100% gain. But in a movement like we saw on September 27th, or the week prior to that on the 20th, which was also a bearish move, the volatility might have increased, and the buyback cost trying to get out of the position before taking the full loss here had the potential to be higher. It's strange when volatility works that way, but even though you're 1 day to expiration and it breaks through it, on a down day the volatility might spike. The market maker's charging you more to buy this one back. You might get a little bit more to sell to close this one, but it's going to be a fight. You leave it through expiration and it's below both strikes, you just take the 100% loss. It's kind of a gamble there. Hopefully you can close it for less than 100%, but volatility fluctuations are going to be very difficult to take. Another comment on that is that on a day like the 27th you're seeing here, when the market did open down, don't worry, I'll show the chart again in a second, is that these positions here that are below both strike prices, it didn't suddenly go down and then continue to go down necessarily the rest of the day. It pretty much went down at the open and then maybe dropped a little bit more as the day went on. So you were already at 100% loss in the first 10-15 minutes of the market open on the 27th and on the 20th. Possibly even the 13th, even though that was the orange day, which didn't look like that big of a move, but some stocks and sectors were hit harder. You want to make sure you weren't in those as well. So moving on here from that comparison, this was just the Thursday, and the Wednesday on the 27th would have been about the same. Less than 50% winners, loss of 33 or 32% would have wiped out the gains that we had from October 4th. And this week might have countered it, so you're just close to the profit that you want. So again, on a movement like the 27th, where we saw SPY only drop from about 298, shot down to 292, and then it did settle back up at 294 there at the close, but only a 4-point drop in the SPY was enough to take out half of the bull put credit spreads. Okay, this one was very similar. 300, 301. On the day, it dropped immediately. It opened at about 301, but by the end of the day, we were down to 298, another 3 or 4 point move. Only half of the bull put spreads were right. This one was about 25% of the bull put spreads opening on Thursday, and Wednesday, 25% were wrong, 75% were profitable, but lower than that 93% we saw roughly. You saw 100% today, but for just the bull puts, lower than that 93% we saw on October 4th if opened on Thursday, and the 86% we saw if we had opened, and this was actually a small loss of around 8% average for the top 15 positions with not much of a big move. Okay, so again, let's just take the broad question as a whole. This is not a strategy I advocate because it's not a strategy I've traded, and it's not a strategy I've tested. Looking at the numbers so far, I wouldn't advocate clearly, as you mentioned, Chuck, of just doing bull puts or just bear calls. I need some kind of other verification if I'm trying to do a 1-day or 2-day bull put spread or a bear call spread, something I really feel confident in to know if I'm going bull or bear, or if it's even worth it to try 2, unless you're doing inverse ETFs along those lines. What you saw today was the biggest gap upwards, so I'm impressed that you had bear calls that were successful today if they weren't on inverse ETFs. But again, we saw how hard it was and how we'd lose more money on this end doing comparable spreads, perhaps with fluctuations during the day and a big decline and increase in volatility, than we might have made here, and then we would have made it maybe back up here, but then we would have been down another 33% here, so we'd still be overall negative. Even this was a small decline, average being right 3 out of 4, about 73%, I think it was 73% winners on the 13th, but with an average loss of 8% on all of them. What I can't, that's just a synopsis and a review of what I can give you with the tools that I have. I think this has to be paper traded personally more to see the actual performance with alerts that you would apply in your trading plan on fluctuation days, on bad days, on even not so bad days, to see how it operates. What's difficult for me, and I'm not going to say it's a flaw, it's just the way that the system works. And the historical tools, as you've seen, are very powerful for these types of illustrations. I just ran the bull put back test on power options, ran that search that I created for you, got the results, then calculated the top 15 results for that strategy so I could see how it would have performed. What I mean by a flaw is that opening it on the 26th, when I ran the search on the 26th of September or on the 3rd of October, that was at end of day data. When I ran it on the Wednesday for the 2nd of October or on the 25th of September to simulate Wednesday for the 27th, that was at the close of those Wednesdays. So if I'd opened the positions at about 3 p.m. on Wednesday or 3:30 p.m. Wednesday or Thursday, that would have been close to accurate. What I can't do is see what positions would have matched at the open on Wednesday or Thursday. So Thursday would have been in for almost 2 full trading days to the end. Wednesday you would have been in full 3. But it's still relatively close to what you'd expect. If you're opening your positions in the afternoon, either on Thursday for the Friday expiration or Wednesday afternoon for the Friday expiration. I could go back and do Tuesday as well. But I personally think it needs more testing because I don't know how you're using the vantage point there in conjunction with power options, and I approve of this. I approve of using outside sources if you're confident with what those tools give you, and it really sounds like they are today, that they worked out for you, and we've talked before, Chuck, about this as well. Going back to this discussion here that we're looking at is that, yes, opening on Wednesday, Sam had mentioned this. Sam mentioned this again as I'm scrolling through. That's why you're hearing the clicking there. I'm going back through. But you're likely to get a better premium for the extra time by opening Wednesday instead of Thursday. But it does give you more time to move against you as well. This one, either one, Wednesday or Thursday, would have been disastrous for these 2 cycles. Let's just cross those out. This one here, you can see that with if I'm opening bull puts, and I know I'm just talking about bull puts, but in this case, the market was down beginning on Wednesday, but it started to move back up. So I probably could have gotten much better premiums here. Just had an average day on Thursday and it declined. But again, we still saw that 8% loss being right 75% of the time. Okay. Yeah, and it's important to remove those other factors I mentioned, earnings, do the other analysis there as well to avoid things that might have, I apologize, earnings report or beyond that as well. I'm sorry, such as the patent lawsuits or trials as we're seeing with J&J and other positions as well. Okay, so I'm scrolling through Chuck's comments here. Is this, okay. All right, so Chuck says, fantastic commentary. You've convinced me to upgrade to the access to historical backtesting. Yeah, the benefit of the historical backtesting over paper trading is you don't necessarily have to wait till next week to start running your analysis of if you opened Wednesday, if you opened Thursday, and so forth. And Sam's comment going forward is, you can tell, Chuck, it's similar to mine, is he articulated a little bit better here. One of our regular Sam says, I think this strategy will give you inconsistent trading experience, which I don't like, simply because the volatility is so high, because the next news item that comes out could swing the market one direction or the other. So it's very difficult in that sense to do that. Not do that, but when you're expecting a bull and then Friday turns into a bear because someone opened their mouth, a rocket got fired in the Pacific, and etc. The headline-driven news markets drive us a little bit nuts. Now, the volatility can lead, of course, to better premiums, but it also might give us inconsistency on our expectations. What chart patterns showed us, thrown out the window in an instant because something went one way and something went the other way. Globally, internally, anywhere along those lines. Okay. Sam comments on some of his trades with the 50 calls he had in IWM. I mentioned his comment on there on Wednesday. He's talked about Beyond, which came up twice in those historical searches. Beyond is very volatile right now, but he had a good position on Beyond. It's high volatility, can be $50 away from it in the money. So in one day he could be successful with a bull call, a debit spread, or a straddle in that case due to the volatility, although the costs might be high. You sell the premium against it. And you had Apple calls as well that you got out of the 125 Apple calls Sam comments on that worked well for him this week. Okay. All right. Okay, so Thomas's question was the first one live. I didn't have a time to do a summary slide for you today there, Chuck. I finished this right at 4:29, so that's why we were 1 minute late starting the webinar.